Hey, Scott, how would you understand and categorize the last 48 hours of trading?
Well, I think probably what I'd focus on is an unwinding of positioning that going into Q3 was pretty strong and confident and is now coming into question. So specifically, if you look at the way we characterize the three forces at work in the market over the past couple of months, first has been the AI growth tailwind, which is manifested in the mega cap growth part of the market doing quite well. The second has been an ongoing view that soft landing is becoming increasingly the base case, which has allowed for a Goldilocks setup for many investors. And then the third, obviously, is how one thinks about election outcomes and impacts. And there, I think the early read on the Trump lead in the polls set up for a positive equity response around deregulation and so forth. All told, those three drivers of positioning are coming into question right now.
They're coming into question right now, and the jobs report on Friday is a big reason why. That kind of got people thinking again that the labor market is deteriorating a lot quicker than the Fed may have appreciated. Liz McCormick was just on saying that this week's data is really limited to the ISM services we got today and jobless claims on Thursday. And on the earnings front, it feels like we don't get anything significant until NVIDIA at the end of the month. So until then, what's going to be the catalyst that you're paying attention to?
Well, we're watching the positioning and we're saying, hey, look, we have to let this unfold and play out for a while, right? So to the degree that investors were pointed down a fairly constructive path, and a lot of the premise for that is now coming into question, we have to allow some time. So the way we had framed it going into Q3, actually, we had lifted our target to 5,600 for the end of the year, which gave us a couple of percentage points of upside. But we were really saying, hey, look, there's a lot that's extended here. We have to allow for a 5 to 10% pullback. We're getting that 5 to 10% pullback. We're right at about 5% now. And I think what we have to just assume in here is that the questioning continues, the uncertainty continues, and with that, some unwinding risk. But under the surface, color is still quite constructive on the U.S. equity fundamental setup. So we think that the S&P is still beating to a slightly different drummer in terms of a Wall Street approach versus Main Street in the broader economy.
So just to be clear, 5,600 is your target. Do you stick by that number, and just how we get there is different?
Yeah, no, I mean, look at, so we had gone to 5,600, as we hit the midpoint of the year, and our call was very clear. The risk reward isn't super fantastic from that starting point. Allow for some of the excesses to work their way off. We thought the Q2 reporting period would be a trigger for that. We've seen some evidence of that. As market pulls back, you begin to set up a better risk reward setup into the end of the year. Now, somewhere in there, we're presuming an increase in volatility around the elections. And then as you get through the elections, usually there's an alleviation of that uncertainty coming out the other side. All told, we think this pullback ultimately becomes a buying opportunity, but we do need to let the dust settle in terms of this repositioning angle that I keep coming back to.
We talk a lot about the election, and of course there's a lot about positioning as well, but I know that you and I were talking earlier about how, Alex, there's a lot of people trying to get ahead of thinking there might be a change in administration, or certainly there's going to be a change in the leader at top, but how they want to position for potential tax changes as well.
Well, that's right. It's really changes in capital gains tax. Like, do you need to kind of get ahead of that, which brings me to kind of Buffett and what happened with Apple. Hey, Scott, can you walk us through what the election might be playing out right now in markets also?
So the way we've been thinking about election, a little bit different from many. We've been saying that both candidates, or parties, if you will, are equity negative. We've focused in on tariffs and taxes as the two main decision points. While we all care about social issues, they're a little bit less impactful on fundamentals. So where's the biggest fundamental issue? With Trump, it's how you incorporate tariffs, and there our concern has been that would be fundamentally disruptive to earnings. As Vice President Harris moves up in the polls and you have the Democratic profile now kicking in, there's, in our view, increasing burden on pushing tax rates higher to offset a lot of other spending initiatives. And in that scenario, that's potentially a negative for U.S. equities as well, as we've been living in sort of a lower tax rate regime over the past several years. So in both cases, we have issues with the candidates. There are some flip sides. With Trump, you get deregulation. and his potential push down lower taxes, but we'll take the deregulation as an offset to tariff concerns. With Vice President Harris, we're still looking at that spending inertia, which, kind of keeps the fiscal accommodation part going. But if you pay for it via higher taxes, what you do then begin to do is cloud the S&P 500 fundamental picture, as well as with other parts of the U.S. equity market.
Got it. Thank you for explaining that. And interesting that both candidates are equity negative. Having said that, I know there's a lot of discussion. I'm sure clients are asking a lot of questions about the elections and the potential impacts. But to what extent are they already positioning for it? I feel like it's more discussion and thought operations right now than active positioning.
I think there's a lot of discussion, and there's probably some positioning or hedging put on around Trump trades, Biden trades, now Harris trades. Got that. But in terms of an aggregate portfolio positioning around the election, I don't know that we've seen that in aggregate just yet. It's quite interesting. Again, among the backdrop issues that we think we need to contend with next year is the growing deficit situation. And a concern we've had has been that you would see a backup in interest rates. Let's call it the bond vigilantes returning into the spectrum here, as investors are dealing with an ongoing new supply of U.S. Treasuries. You turn around and look at what's happening with 10-year yields right now, and it's like that issue seems to be off the table relative to more recession-type concerns. So we're back and forth. I think right now the election's probably taking a little bit of a backseat to what's happening in terms of the underlying economic circumstance and the Fed. But I think as we go from now into the end of the year, we have to remain centered around a view that, hey, look, this is going to be an evolving, changing landscape that we're going to have to keep adjusting to. From our perch, our ongoing focus is on S&P 500 fundamentals in particular, and there we think we're still in very good shape.